Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in May 2023. Bond markets took a little breather over the course of May with a little bit of a rise in yields. Some of the issues that had been causing some anxiety, certainly around the regional banking crisis in the United States and the US debt ceiling, have abated to some degree, and the focus has returned on economies that are grinding along, employment which remains relatively robust, and certainly incoming inflation data and what that will mean for policy. We've absolutely got to the stage with the policy cycle where some of those central banks that led the cycle, the Reserve Bank of New Zealand is a classic example, have completely paused, believing that their interest rates are now in very restrictive territory, and with that outcome, that will bring inflation down through the balance of this year. In the United States, the Federal Reserve are also expected to pause, and certainly we're very close to the end of the hiking cycle. Again, inflation moderating quite considerably. Similar in Canada, but interestingly in Australia, we've just had a little rise in monthly inflation coming in, which is at odds with some of the other leading indicators that we've been watching. Retail sales have been fairly weak here on a real adjusted basis. Unemployment did rise a little bit, although it's still very historically low. And of course, we know we have this huge mortgage cliff coming, certainly in the second half of this year. That's given the market some expectation that the RBA may have a little bit more to do. But in general, central banks are very, very close to the end. And markets are still expecting that rate cuts can occur very late into the 2023 year or early into the 2024 year. And we still believe that that seems fairly rational. As we look across the globe, a lot of leading indicators continue to be very, very weak, whilst the more laggard indicators are holding up okay. But we have to believe that with the passage of time, economies will continue to slow, as those leading indicators suggest, and that will bring the rate hiking cycle to its conclusion in general. And clearly, inflation is still problematic. It's not coming all the way back to that magic 2% easily. So we must expect that we have a slightly higher term structure of interest rates, and that clearly has implications right through portfolio allocations and the performance of assets. And if we have a debt, cycle that might generate delinquency and some issue. We've started to see the rise in those defaults, particularly in the very low quality space. We must expect that that continues. And so from our point of view, we believe that holding very high quality fixed income continues to make sense, whether that's across the sovereign space or in the upper echelons of the credit sector. That does make sense to us, but certainly things can speed up from here on. But it has taken a little longer than certainly we would have expected. We would have felt that the economy would have slowed more by this point. I guess there are things working against that. The huge influx of immigration coming into Australia at the moment is very helpful. 90% of arrivals turn up in Melbourne and Sydney, putting a lot of pressure on the housing stock, which we know is undersupplied. So it's not surprising to see housing holding up much better than otherwise would have been expected, given those changes in mortgage rates and mortgage availability. We know that credit creation is down. So we do expect that ultimately, though, we will have a slowing economy, notwithstanding there's just been a good solid wage rise for minimum wage recipients from the Fair Work Commission. And that's a little bit of a dangerous precedent because it does start to lift inflation expectations in the economy. It's obviously great that those folks are going to receive that, but it is a very finely balanced type of outcome because you can start to generate those self-reinforcing narrative loops. And so it is dangerous territory. What it may mean is that the RBA do need to go that little bit further, and we might get up just above the 4% mark in terms of where they are going to go. Some economists are now predicting that we can go a little further again, but we do feel that an awful lot has already been delivered. The long and variable lags are very real, and they will hit the economy very hard. And the burden of proof is getting a lot higher for each rate hike, given that the unexpected rate hike that we did receive in May was a very finely balanced decision. Governor Lowe, in his Senate appearance last week, also suggested that rates are already deeply in restrictive territory. Therefore, there isn't a huge amount more to do, where it should start to take care of itself. So we do expect that we're very close to the end. We think from there on, obviously, bond markets can perform pretty well throughout the summer period, and northern summer period, through our winter, as is often seasonally the case. Thank you very much.